Thursday morning, this bank looked normal. Deposits were flowing, executives were calm, no alarms, no warnings. By Friday afternoon, it no longer existed. $200 billion vanished, thousands of companies froze, and the global tech economy held its breath. This wasn't a cyber attack, it wasn't fraud, and it wasn't a recession. This was a failure hiding in plain sight.
Silicon Valley, innovation, risk, speed, and a bank that forgot one rule. Trust moves faster than money. Silicon Valley Bank wasn't built for regular people. No car loans, no suburban mortgages, no everyday savings accounts. SVB served one group almost exclusively. Startups, founders, venture capital firms. If you were building the next tech unicorn, this was your bank. By 2021, nearly half of all venture-backed startups in the US banked with SVB. That focus made them powerful. It also made them fragile. Because startups don't behave like normal customers. They raise large amounts of money, they burn cash fast, and when fear spreads, they move together. SVB knew this. They just believed the good times would last.
This is the second biggest bank failure that's ever happened in the United States.
After 2020, money became cheap. Interest rates dropped near zero, venture capital exploded, startups raised billions. SVB was flooded with deposits, but banks can't just sit on cash. They invested. SVB chose what looked safe, long-term US government bonds. At the time, this decision seemed conservative, stable, predictable, but there was a hidden problem. When interest rates rise, bond values fall. SVB locked massive amounts of money into assets that would lose value the moment rates changed. And rates were about to change fast.
These clients would definitely be considered risky. These are companies that move quickly, and their money moves quickly. When things sort of went off the rails, they were quick to move their money out of the bank.
In 2022, inflation surged. The Federal Reserve responded aggressively. Interest rates climbed faster than at any time in decades. Suddenly, SVB's safe investments were worth far less. On paper, the losses were unrealized. Technically, nothing had happened yet. But startups were changing too. Funding slowed, layoffs started, cash burn accelerated, clients began withdrawing money, and SVB didn't have enough liquid cash to handle a mass exit. This was the moment where leadership needed clarity. Instead, they hesitated. Most banks diversified, different industries, different customer behaviors, different timelines. SVB did the opposite. Same industry, same risk cycle, same reaction speed. When one startup pulled money, others noticed. When venture firms warned founders, panic spread instantly. Slack channels, group chats, private messages. Fear moved faster than official statements. This wasn't a bank run from the public. It was a bank run from insiders. People who understood exactly what was happening. SVB decided to act. They announced plans to sell assets and raise capital. On paper, this was logical. In reality, it was fatal. The announcement told customers one thing: the bank needs help. Within hours, withdrawal requests exploded. $42 billion attempted to leave in a single day. No bank can survive that. By the next morning, regulators stepped in. Silicon Valley Bank was done. Employees showed up to lock doors. Founders couldn't access payroll. Startups around the world froze operations. For 48 hours, the tech economy existed in uncertainty. Not because money was gone, but because trust was. The government stepped in to stabilize the system, but SVB was finished. A 40-year-old institution collapsed almost overnight. SVB didn't fail because banking is broken. It failed because leadership misunderstood risk in a changing environment. They bet on stability in a volatile world. They trusted history instead of adapting. They assumed loyalty would override fear. It never does. Modern failures aren't loud. They're quiet, technical, and then sudden. SVB collapsed in days, but not all giants fall that fast. Some collapse slowly, publicly, with warning signs everywhere. In the next episode, we investigate a company everyone shopped at. A retail giant that ignored the future while standing in it. Its failure took years, and no one stopped it. Because in Banana Republic, power doesn't mean protection.